Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years. He's a graduate of MIT and Boston University. He's not a typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. Our goal in reviewing the economy every month is to get some insight into the dynamics that influence real estate markets in both the short and the longer term. This month, for the first time since the start of the pandemic, we have good information about home prices. And it shows two things: that there is so far no sell-off of homes, no sharp drop in prices, but also that price increases are in fact slowing, as they already were before the recession. Overall, home prices in the second quarter of 2020 were up 4% from 2019, the lowest annual rate in 7 years. Looking at some individual markets, prices were up 10% in Boise, 7% in Phoenix, 6% in Tampa, 4% in Las Vegas, Los Angeles, and Atlanta, but up just 3% in New York City and Dallas, 2% in Chicago, and they were down 3% in San Francisco. We need to keep in mind that these price data come from home sales that were closed in the second quarter. The prices often were decided months earlier, so we don't really know how much they reflect the pandemic. We'll find out more in November, but I believe we'll see slower price increases over the next 2 years. Maybe around 2% in 2021 and even lower in 2022, before they pick up more briskly in 2023. My home price forecast is based partly on my recession forecast, so let's have a look at that. On this chart, we see retail sales in blue and jobs as the red line. These are percent changes from the last year. The recovery in retail spending looks pretty good so far, although the numbers don't yet show the impact of the end of stimulus support. But the recovery of jobs clearly would be a much longer process. In August, the loss compared to last year was 7%, just a bit better than the 7.7% of July and the 8.7% of June. We seem to be at a point where the improvements will get smaller and smaller because a lot of jobs are now gone for good. Remember that during the last recession, in 2008, job losses only reached 5%, and they didn't get back to their original level until 7 years later. This is a different type of recession, and I don't think the recovery this time will take as long, but it will certainly stretch over several years. Let's quickly run through the situation in the various job sectors. A common theme in many, but not all of them, this recession hits lower paying jobs more than others, is that the initial recovery of jobs has petered out. Here's total jobs again. It's the same as the red line, but a bit clearer. Manufacturing jobs seem to have completely hit a wall. As have construction jobs. These are both sectors where government policy can ultimately make a big difference. As states reopen their economy, retail jobs have shown the biggest recovery. Business service jobs, one of the largest sectors of the economy, are creeping back and will determine how fast the overall recovery proceeds. Jobs in healthcare have pretty much followed the same path as jobs in business services. Finance jobs were the least affected, but the loss of jobs looks like it may be permanent. Like retail jobs, restaurant jobs have made a big recovery as states reopened, but they seem also to have hit a wall at 20%. Teachers are a big part of government jobs, and we'll have to see what happens as schools try to reopen. Finally, my homeowner recession indicator, computer programmers. These are well-paid jobs. These are people who have driven home prices in many local markets. Both the recession and the lower demand for homes won't be over until we see these jobs increasing again. To finish, let me plug our Investors Metro analysis, which shows the economic situation in any of 200 metro areas and what that means for local investing, especially in rental properties. It now includes detailed rent data and analysis for local zip codes. It's especially useful in uncertain times like these. Thanks very much for following along. This is our National Economic Outlook. I'm Inga Windsor.